In this video, I want to discuss what rising interest rates mean for you and how they will affect your mortgage payments. So stay tuned. Hello everyone, if you're new here, my name is Abbas Pardhan. I'm a property investor and I'm an owner of an estate agency called 10x Rising. On this channel, I share with you the inside of what I go through on a day-to-day basis that may help you on your property journey. So if you enjoyed the content, smash the like button, subscribe and hit the notification bell so you do not miss the next videos. So let's begin by having a look at how interest rates work, why they change, and how will you be affected. So the first part that we all need to understand is the difference between the bank rate and the interest rates that we get charged as customers taking a loan. The bank rate is the key interest rate that is set by the banks in England, the Bank of England. That is the rate that commercial banks will pay to borrow the money of Bank of England. The bank rate is currently set at 3%, which was increased on the 3rd of November 2022. It has been the highest since 2008 and it has been the 8th rise since 2021. So the bank rate influences all other types of interest payments around in the UK. So now we have established what is the difference between a bank rate and the interest rate that we get charged from our commercial or residential lender. So now what is an interest rate? Right? So an interest rate is the amount we pay, the cost that we have to face to borrow the money of a lender. It's quite simple. The higher the interest rate, the more you have to pay back. The cost that you face to borrow that money is broken down into percentage. So generally, the lenders will look at the bank rate first and then will establish the lending rate that they will hit you with to make sure they're making a profit in the middle. That's where you get different types of products, whether it's a commercial product they have, it's a fixed product, variable product, is it a bank loan, is it a business loan, what sort of a loan it is. They always look at the bank rate first. How much is it costing them, the lender, to borrow the money of Bank of England? So broadly speaking, if the bank rate keeps going up and up and up, now it's at 3%, then goes up to 4% or 5%. I'm not saying that it will, but I'm just giving you an example. The higher it goes, the higher you're going to have to pay back as your mortgage payments. Quite simple, because the lender is going to look at what the base rate is, how much they want to make on top, because they need to look after themselves as well in case the bank rate goes up. Are they going to give you fixed mortgages or not, depending on how the bank rate is acting at the time. So the higher the bank rate, the more you're going to have to be paying back every time. So let's get into why interest rates go up and down in the first place. Generally, the Bank of England's MPC will generally look to change the bank rates when it wants to encourage or discourage spending in the economy. The MPC will generally look at Consumer Price Index, known as the CPI. They will look at that to monitor and measure whether the cost of goods and services is going up or down. They need to know if there is inflation in the market and how high the inflation is going up to. If they realize that inflation is going up too quickly, then they are going to increase the bank rate because they want to make it more difficult for people to lend money because they want to encourage savings. They don't want people to go out spending out there, because the more you spend, the more everyone is spending, then automatically the prices of goods tend to go up. What happened during COVID? Everyone was getting free money. There was a lot of money being printed. Everyone had access to a lot of money. What generally tend to happen then is prices of goods started going up and up and up. So now in that case, they need to bring that inflation back down. So they increase the cost of borrowing so that you are not spending anymore, because now there's the money is tight in the market. Not everyone has easy access to it. So that they bring inflation back down. Basic. Likewise, if they realize that inflation has gone down or has stagnated for a period of time, then they will want to boost the economy to get people to start spending a little bit again. So they will decrease the bank rate so that people can now borrow money again to start spending, just to boost the economy back up. So let's have a look at how a higher bank rate will decrease inflation. Generally, when a bank rate is very high, businesses and people will be discouraged to borrow. Why? Because they're going to have to pay back more. So because we're going to have to pay back more, we all start tending to spend less because we're not borrowing anymore. So if you're spending less, automatically demand becomes low. And if the demand is low, prices do not go up so quickly, or even they go down at times. And this is how they reduce inflation. So the government's target is to bring down inflation to 2%. and currently it's at 10.1%, so there's still a big gap, and that's why the Bank of England has now increased the bank rate to 3% from 2.25 on the 3rd of November 2022. So how high can the interest rates even go? You might even have heard of the horror stories from the 1920s or even from the 1970s. In 1979, the bank rate's base rate was at 17% in comparison to what it is today at 3%. But the truth is, the situation back then was very different because the bank rate was being set by the governments, and as a result, it was very much more volatile. Whereas today, as of 2022, the MPC can only change the base rate up to 8 times a year. Since the global financial crisis in 2008, the interest base rate has been at a historic low level. In 2021, we were looking at 0.1%. That's it. So it's very unlikely that we will see the base rate go up as it did 45 years ago at 17%. It's very unlikely. But that's not to say that the base rate will not go up again. It is quite predicted that when the MPC sits down again for the next review, the base rate will go up again. And that's just what the prediction is. So let's have a look at how interest rates affect your mortgages. Let's take an example where you bought a property a couple years ago and the borrowings you had taken was £150,000. Now at that time, the base rate set by Bank of England was at 0.1%. So because of that, the lenders who were lending money of Bank of England to borrow it to you, lent it to you at 2%, keeping their margin in the middle, and also looking at worst case scenarios, what happens if you don't pay back, etc, etc, etc. So let's say 2% is what you got the mortgage at. If you take £150,000 times 0.02, you were paying £3,000 a year. Divide by 12, you were paying £250. So if your rental income was £750 a month, you're paying £250 here, you're left with £500. You're paying your management fees and maintenance fee, and you still got a bit of profit for yourself while you wait for the property prices to appreciate over time. That's a good case scenario. What happens in today's market? Let's take the same example. You've had £150,000 of borrowing, but now the base rate set by Bank of England is not 0.1% anymore. Now it's at 3%. Quite a big jump up. So if it's at 3%, realistically at the moment, a buy-to-let mortgage offered by banks right now, you're looking at about 5.5 to 6%, in some occasions even 6.5%. So let's just take an example. If you were to pay 5%, you've got good credit history, the lenders like you because you're an experienced landlord and you have that reputation built with them. It's the same company borrowing, they know you've got some equity in the deal, so they're going to give you at 5% instead of 6%. So same amount, £150,000 at 0.05%, that's £7,500 a year. Divide by 12, you're paying a big chunk of £625, and that's just your interest payments. If your rents are still the same at $750, you pay back the $625. What are you left with to pay for your management fees and then the maintenance fee? It's just not worth it. The model just doesn't work anymore if that's how high you'll have to pay. Unless the rents start going up, that's a different case. If you can increase the rents, then it still works. Do not forget the capital appreciation. So I'm not saying that this model doesn't work, but I'm saying if this is how it's going to remain forever now, rents are not going to go up and this is how interest rate payments are always going to be, then the model will not work. However, this is not how it's going to be forever. We all know it. Markets always go down and then come up. There's always a boom and then a bust followed by a boom. So again, this market will recover and prices will go back to how they were. Interest rates will come back down because it's just what the governments are trying to do. What the MPC is trying to do is to reduce inflation. So do not panic, but this video is just to explain you how this works. But again, see, not all borrowers, not all property investors will be affected by this because there are different types of mortgages out there. Now let's just take an example. If you took a loan at $150,000 in 2021 and you fixed it for 5 years, then you're not going to be impacted by this at all. Because maybe until 2025, 2026, if you took it in 2021 and you fix it for 5 years, by the time 2026 hits, maybe this whole economy crisis is now gone away. Inflation is back at 2% wherever the MPC wanted it to be, and now the market is again going up. Then you're okay. It's not going to affect you at all. However, if your fixed period is coming to an end now, then you will be affected. And ideally, you don't want to leave it till the last moment where your fixed rate has now come to an end and now you're on that variable rate. That's going to be quite high up. Ideally, what you want to do is right before it comes to an end, couple months beforehand, you need to already be looking for lenders out there to try and find the best rate for yourself. However, if you're a landlord and you are on a standard variable mortgage, then as the bank rate pushes up their base rate, your lender is already going to be experiencing their costs going up. So automatically they're going to push that cost onto you because they can't incur that cost because you're in a variable mortgage. So you will see your mortgage payments go up, but it's not necessary that your mortgage payments increase will be aligned and accurate to what the base rate is, because it all depends on the cost that the lender is now starting to face. However, if you have a tracker mortgage, then you will see an instant rise in your payments increase every month. As the bank rate pushes their base rate up, you're going to have to pay more because you're on a tracker mortgage that's working in line to what the base rate is. Of course, with an add-on that your lender will tell you that you're going to be paying the extra 2%, 1%, 1.8%, whatever that is that you've discussed with your lender. But this is just to inform you that if you're on a tracker mortgage, then you will see that bump up as soon as the base rate goes up. So this also means that if you've got money saved in the bank and the base rate is now at 3%, that means you're going to get 3% back on your money that you've saved as well. It can sound like good news, but guess what? It is not good news, because the cost of goods and services rising is a lot more than even the 3% that you're getting back. So automatically your money is just shredding and devaluing anyway. So keeping the money in the bank is not something that I would recommend to you. Put it into property, enjoy the capital appreciation, wait for your property prices to increase, because they will. Like I said, it's a boom bust boom. So the property prices will increase, but at the same time you could also enjoy from your rental income. I've mentioned in a few of my other videos is that you do not need to wait to time the market. You can look for below market value properties, run down properties that you can add value to, refurb, refinance, pull all your money out, and then jump onto the next cycle. You can do that. In current time, it's a buyer's market now. So if you're well connected in the market and you are a serious cash buyer, or you have money in the bank and you've got a good reputation with the lender, then you have a lot more deals to choose from now than you will have ever later on. So to conclude in this video, if you are struggling with your mortgage payments, do not miss a payment, because unless you're in the short-term game, real estate is a long-term game. You want to have the lenders in your power team, because they are the ones that will help you buy good real estate. See, if I had 250,000 in my bank, I don't see that as 250,000 pounds in my bank. I see it as 1 million pounds into my property. That's how I can leverage my cash in the bank. So I'm not in this for a short term. I'm in it for the long term. Lenders are my best friends. I wanna have that reputation with them. You don't want to miss any payments. If you think you're struggling, then get in touch with your lender, and they have that customer support specialist team who will help you and work around it to make sure it doesn't damage your reputation and your credit history. So get in touch with them. So I hope this video has kind of given you just an understanding of how interest rates work, what's the difference between the bank base rate and what is the interest payments that you pay back to your lender, how it all works, how it affects you, your money in the bank, and how it will affect your mortgage payments. If you have enjoyed this video, please smash the like button. Do let me know in the comment section as well. I do put in a lot of effort to make these videos for you, and I will see you in the next one.